Let me tell you about two people. Person A earns $200,000 a year. They are a doctor. They work 60 hours a week. They are excellent at what they do. They pay roughly 32% in federal income tax, plus state taxes, plus payroll taxes. All in, they hand over close to 40% of everything they earn to the government before they see a single dollar of it. Person B made $11 billion last year, not in salary, in wealth. His net worth went up by $11 billion because the companies he owns went up in value. His tax bill, less than 1%, legally. Person A is educated, works hard, follows the rules, pays 40%. Person B is one of the wealthiest humans alive, made $11 billion, paid essentially nothing. Same country, same tax code, same rules. How? That is the question this video answers. And the answer is not a conspiracy. It is not a loophole in the illegal sense. It is a set of legal strategies that have been embedded in the U.S. tax code for decades, strategies that the wealthy use through their accountants and attorneys every single year, strategies that most ordinary Americans have never been shown because nobody whose job it is to teach you about money ever sat you down and explained how the tax code actually works. Today I show you how it works. The billionaire version. And then I show you the scaled-down version, the tools the ordinary American can use right now at their income level to legally pay less tax than they are paying today. This is not tax evasion. Tax evasion is illegal and will land you in prison. This is tax avoidance, using the legal structure of the tax code exactly as Congress wrote it. The difference between evasion and avoidance is the difference between robbing a bank and finding a $20 bill on the pavement. Let us start at the top. First, you need to understand why the tax system treats income and wealth differently. Most Americans pay income tax. When you go to work, trade your time for money, and receive a paycheck, that is ordinary income. And ordinary income is taxed at the highest rates in the U.S. tax code. In 2026, federal income tax rates go up to 37% for earnings above $600,000 for married filers. Add state income tax, up to 13% in California, nearly 10% in New York, and a high-earning professional can easily hand over nearly half of every additional dollar they earn to the government. Now here is what most people do not know. There is a completely different category of income in the U.S. tax code. It is called long-term capital gains, and it is taxed at a maximum of 20% federally, and for individuals earning under approximately $47,000 a year, it is taxed at 0%. Zero. Capital gains are profits from selling assets, stocks, real estate, businesses that you have held for more than 1 year. The U.S. tax code explicitly and intentionally taxes this category of income at a lower rate than the income you earn from your labor. A surgeon who earns $500,000 operating on patients, taxed at 37% federally. An investor who earns $500,000 selling stocks held for 18 months, taxed at 20% federally. Same amount of money. Dramatically different tax treatment. This is not a glitch. Congress wrote it this way deliberately, the argument being that lower capital gains taxes encourage investment and risk-taking. Whether that argument is correct is a separate debate. What matters for you today is understanding that the tax code has two very different tracks, and the wealthy live almost entirely on the lower rate track. Now let us go deeper. Because capital gains taxes, as low as they are not even the main mechanism the ultra-wealthy use. The strategy billionaires actually use is called buy, borrow, die. It has a morbid name. The mechanics are elegant. And once you understand it, you will understand why people like Elon Musk, Jeff Bezos, and Larry Ellison can accumulate wealth measured in tens of billions while paying effective tax rates that would make a teacher feel overcharged. Here is how it works. Step 1. Buy assets. Instead of earning a large salary, which would be taxed as ordinary income, the billionaire owns equity in companies. Their wealth is in stock. The stock goes up in value. That increase in value is called an unrealized capital gain. And here is the critical rule. In the United States, you do not pay tax on an unrealized gain. If you bought Apple stock at $50 and it is now worth $500, you owe zero tax. Not until you sell. The gain exists. It is real. It made you genuinely wealthier, but the IRS does not tax it until a sale is made. This means a billionaire whose net worth increases by $5 billion in a year because their company's stock went up owes no income tax on that $5 billion. It is unrealized. It is gain on paper. It is taxed at zero until they sell. Step 2. Borrow. Now the billionaire has a problem. They are worth $50 billion, but they have almost no cash. Their wealth is in stock. They cannot spend stock at a restaurant. They cannot use appreciated equity to buy a yacht, but they can use it as collateral. The billionaire goes to a bank, a large private wealth bank that caters to ultra-high net worth clients, and borrows money against their stock portfolio. They might borrow $2 or $3 billion using $50 billion in stock as collateral. The bank charges interest, perhaps 2 or 3% on the loan. Here is the genius of this step. The loan is not income. The IRS does not tax borrowed money. You can borrow $10 billion and owe zero tax on it because you have to pay it back. So the billionaire now has billions of dollars in cash to spend funded by a loan, and they have paid zero income tax on any of it. Zero capital gains tax because they never sold the stock. Zero income tax because they did not earn a salary. Just loan proceeds, tax-free by definition. And the interest on the loan? In many cases, deductible against their existing income. The tax code gives them a deduction for borrowing money to invest. Step 3. Die. This is where the strategy becomes truly extraordinary. When a person dies in the United States, assets passed to heirs receive what is called a stepped-up cost basis. This means the original purchase price, what the asset was bought for, which determines the capital gain, is reset to the current market value at the time of death. If a billionaire bought Amazon stock at $10 and it is worth $3,000 when they die, the heirs inherit it with a cost basis of $3,000, not $10. The entire gain, from $10 to $3,000, evaporates for tax purposes. It is never taxed. Not as capital gains, not as income. Nowhere. And the outstanding loans taken against the appreciated assets are repaid from the estate using the inherited assets, which can now be sold at the stepped-up basis. Meaning the heirs sell some stock to repay the loans, but because the basis has been stepped up to current value, they owe zero capital gains tax on the sale either. Buy the assets. Never sell. Borrow against them to fund your lifestyle tax-free. Die. Heirs inherit with stepped-up basis. Loans repaid with stepped-up assets. Total capital gains tax paid across the entire wealth accumulation journey. Zero. This is not a theoretical strategy. This is documented. ProPublica reported on it in their analysis of leaked IRS data. The 25 wealthiest Americans paid an average effective tax rate of 3.4% between 2014 and 2018 on wealth gains totaling $400 billion. $400 billion. 3.4%. You are probably paying more than that on your paycheck this Friday. Now, I want to be honest with you about something. The buy, borrow, die strategy in its full form, with billions in stock, private banks lending against portfolios, and estate attorneys managing the stepped-up basis, requires a level of wealth that puts it out of direct reach for most people. But here is what is available to you right now. At your income level. The same underlying principles, delay recognizing gains, use tax-advantaged accounts, understand how different types of income are taxed differently, are available through tools that Congress built into the tax code specifically accessible to ordinary Americans. 5 of them. And most Americans are underusing at least 3. Tool 1. The Roth IRA. The ordinary American's version of the zero-tax investment. A Roth IRA is a retirement account you fund with after-tax money. You contribute from income you have already paid tax on. The money grows inside the account through investment in stocks, index funds, ETFs, completely tax-free. And when you withdraw in retirement, after age 59 and a half, you pay zero tax on the withdrawals, including all the growth. Zero. You invest $5,000 today. It grows to $50,000 over 25 years. You withdraw $50,000 in retirement. Tax owed on that $45,000 in gains, zero. The 2026 contribution limit is $7,000 per year, $8,000 if you are 50 or older. If you are in a lower income bracket today than you expect to be in retirement, a Roth IRA is the single most powerful tax tool available to you. You pay tax now at your current low rate. You pay zero tax on everything it grows into. A 25-year-old who maxes out their Roth IRA every year until retirement will have approximately $2 million in tax-free retirement wealth, assuming average market returns. $2 million. Zero tax on withdrawal. That is the scaled-down version of the Billionaires' zero-tax investment portfolio. It is available to you at any income below $161,000 as a single filer in 2026. Open one today if you do not have one. Tool 2. The 401k. Delay taxes to a time when you are likely in a lower bracket. A traditional 401k works on the opposite principle to a Roth IRA. You contribute pre-tax money you have not paid income tax on yet. This reduces your taxable income today. The investment grows tax-deferred. You pay tax when you withdraw in retirement. The logic is this. Right now, in your working years, you are likely in a higher income tax bracket than you will be in retirement. You are earning a salary, you are taxed at 22, 24, or 32%. In retirement, your taxable income drops, you draw down investments gradually, you may have Social Security income, but you are no longer in your peak earning bracket. So you defer the tax from your high-rate working years to your lower-rate retirement years. You pay less, not because you avoid tax, but because you time it to your lower-rate future self. The 2026 contribution limit for a 401k is $23,000. $30,000 if you are 50 or older, and crucially, most employers offer a match. If your employer matches up to 3% of your salary and you are not contributing at least 3%, you are turning down free money. Dollar for dollar. That is an instant 100% return on those dollars before the market does anything. The combination, Roth IRA plus maxed 401k, is the core of what financial planners call tax diversification. You have money in accounts that will be taxed on withdrawal, and money in accounts that will never be taxed on withdrawal. You can manage your tax burden in retirement by drawing from each in a ratio that keeps you in the lowest possible bracket. This is exactly what wealthy Americans do. They hold assets in multiple tax structures and control which ones they draw from and when. You can do the same version at your scale. Tool 3. The Health Savings Account. The triple tax advantage nobody talks about. The SA is the most overlooked account in the U.S. tax code, and it has something that no other account has, a triple tax advantage. Contributions are tax-deductible. The money grows tax-free inside the account, and withdrawals for qualified medical expenses are tax-free. Tax-deductible going in. Tax-free growth. Tax-free coming out. No other account in the U.S. tax code does all three. The Roth IRA is great, but you contribute with after-tax money. The 401k is great, but you pay tax on withdrawal. The SA does all three. To contribute to an SA, you must be enrolled in a high-deductible health plan. In 2026, you can contribute up to $4,150 as an individual or $8,300 as a family. Here is the strategy most people do not know. You do not have to spend your SAW money on medical expenses each year. You can invest it. Most SAW providers allow you to invest in index funds once you reach a certain balance and let it grow for decades. Then, after age 65, you can withdraw it for any purpose, not just medical, and pay only ordinary income tax, exactly like a traditional 401k. But if you do use it for medical expenses at any age, it comes out completely tax-free. Funded, invested, and left alone for 30 years, ANHA can grow into a significant tax-free medical fund that covers what will likely be one of your biggest costs in retirement. Tool 4. Capital gains rates, the tax rate your investments already pay at. Remember the difference we discussed at the top between ordinary income and capital gains. This tool is about using that difference intentionally. When you invest in a taxable brokerage account, not an IRA or 401k, just a regular investment account, and you hold your investments for more than 1 year before selling, any profit is taxed at the long-term capital gains rate. In 2026, long-term capital gains rates are 0% for single filers with taxable income up to approximately $47,000. 15% for income up to $518,000. 20% above that. This means if you are a single person with a salary of $40,000 and you have taxable capital gains of $5,000, your capital gains are taxed at 0%. Zero. And even for higher earners, paying 15% on investment income versus 32% on salary income is a significant difference. The strategy is simply to be aware that how you hold your money and how long you hold investments before selling dramatically affects the tax rate applied. Long-term investors who buy index funds and hold them for decades, never triggering short-term capital gains, are already participating in a version of the Billionaires strategy. Every year you hold without selling is another year you do not pay tax on the gain. The gain grows. The tax bill is deferred. Time works in your favor. Tool 5. Real estate depreciation. The paper loss that reduces your real tax bill. This one is more advanced and more specifically relevant if you own rental property or are considering it. But it is worth understanding because it illustrates a broader principle about how the tax code rewards ownership. When you own a rental property, the IRS allows you to deduct depreciation, the theoretical wear and tear on the building, from your taxable income each year. Residential rental property is depreciated over 27.5 years. So if you own a building worth $300,000, not including land, you can deduct approximately $10,900 per year from your taxable income. This is a paper loss. The building is not actually losing value. In most markets, it is appreciating. But the IRS lets you take the deduction anyway. Against your rental income, and in some cases, depending on your income and participation level, against your ordinary income. Real estate investors with multiple properties can generate significant paper losses from depreciation that offset their actual earned income, reducing their taxable income legally, while the underlying assets continue to appreciate. This is one of the primary reasons wealthy individuals buy real estate beyond just the rental income. The depreciation deduction is a legal mechanism to reduce tax on income from other sources while building ownership of an appreciating asset. At your scale, even one rental property, structured correctly, can generate depreciation deductions that reduce your taxable income by thousands of dollars per year. If you are considering real estate, understanding depreciation is not optional. It is one of the core reasons the numbers work. Let me bring all of this together, because there is one principle underlying everything in this video, both the Billionaire version and the ordinary American version. The U.S. tax code taxes labor more than it taxes capital. Income you earn with your time, your salary, your hourly wages, your freelance income is taxed at the highest rates, ordinary income rates, up to 37% federally. Income generated by assets you own, investments appreciating, dividends, rental income structured correctly is taxed at lower rates, often dramatically lower, sometimes zero. This is the fundamental structure of the code. It has been this way for decades. It was not designed by accident. Wealthy people own assets. The code rewards asset ownership. The path to legally paying less tax is not to cheat the system. It is to shift, over time, deliberately, using the tools available, from being someone whose income comes primarily from their labor to being someone whose income comes increasingly from assets they own. That shift does not happen overnight. It starts with a Roth IRA at $7,000 a year. It grows with a maxed 401k. It is accelerated by investing the difference between what you earn and what you spend into a taxable brokerage account. And eventually, for the most patient and consistent, it results in a portfolio large enough that the capital gains rate, not the ordinary income rate, becomes the primary lens through which you are taxed. You will not reach 0%. That level requires the kind of wealth and legal infrastructure that is genuinely only available at the top. But moving from a 32% effective tax rate to a 20 or 24% effective rate through the entirely legal use of Roth IRAs, HSAs, 401ks, long-term investment strategies, and for some real estate depreciation represents real money over a lifetime, not hundreds of dollars, hundreds of thousands, for following the rules exactly as Congress wrote them. The billionaires did not make up these rules. Congress wrote them. The billionaires just hired people to read the whole book. Now you have read it too. Subscribe for the next arc. See you there.